Quantitative easing, will it cause hyperinflation? I'm going to explain this to you in 3 simple, fast steps. And make sure you stay to the end of the video because I'm going to explain why there is a central banker on my whiteboard with hearts all around him. And trust me, you don't want to miss that. But step number 1, we're going to look at quantitative easing through the eyes of a central bank. To do this, we're going to go straight to the Bank of England's YouTube channel and watch their short video on how quantitative easing works. And I'm going to do my very best, guys, to get through this without making too many sarcastic comments in the process. I can't promise you I won't make any, but I'm going to try to get through as much as I can.
Quantitative easing, how it works. The Bank of England's Monetary Policy Committee has been purchasing assets financed by new money that the bank creates electronically. Often known as quantitative easing, this policy is designed to inject money directly into the economy. This is in response to a sharp fall in demand as businesses and consumers reduce their spending. In short, there's not enough money in the economy.
I want to point out and emphasize how they are trying to deceive you into believing that currency equals consumption. And if you think that's true, make sure you go back a couple days and watch my video on the difference between money and currency. But as most of you know, currency does not equal consumption. Production equals consumption. And you see this theme play out through the entire video, and it's central to the central bank's belief system. They think that currency in and of itself creates consumption.
The aim is to boost spending to keep inflation on track to meet the 2% target. Alongside its decisions on asset purchases, the Monetary Policy Committee continues to set bank rates each month. The bank purchases assets from private sector businesses, including insurance companies, pension funds, high street banks, and non-financial firms. Most of the assets purchased are government bonds. There's a large market available, so the bank can buy substantial quantities of assets fairly quickly. The Bank of England's injection of money into the economy works through different channels and has a variety of potential effects. When the bank buys assets, this increases their price and so reduces their yield.
And when she's referring to assets, she's talking about bonds. So in the United States, that would be treasuries. When the Fed or the central bank prints money, they go into the market. That creates more demand for those bonds. If there's more demand, the price of the bond goes up. And because there's an inverse relationship between the price and the yield or the interest rate, as the price goes up, the interest rate or yield goes down.
That means the return on those assets falls. This encourages the sellers of assets to use the money they receive from the bank to switch into other financial assets, like company shares and bonds. As purchases of these other assets start to increase, their prices rise, which pushes down on yields generally.
I've got to commend them for their honesty, really. And at least they're willing to admit that the reason they're doing quantitative easing is just to boost asset prices. I don't think the Federal Reserve would willingly admit that to the public, and definitely not on a YouTube video. But at least they're coming out and saying it, hey, we're doing this specifically to raise asset prices.
Lower yields reduce the cost of borrowing for businesses and households. This, in turn, leads to higher consumer spending and more investment.
And this is where they completely get it wrong, and I'm going to explain in detail on the whiteboard in just a moment.
Of course, higher asset prices also make some people better off, which provides an extra boost to spending on goods and services.
And I want to point out, did you hear what she said there? The increase in asset prices makes some people better off. So she's admitting that they are basically trying to boost asset prices, which is going to create more wealth inequality. Again, you got to appreciate their honesty.
The Bank of England is also buying smaller amounts of private debt, like corporate bonds. These purchases are aimed at improving conditions in capital markets, making it easier for companies to raise money, which they can invest in their business. There's another way the bank's purchases of assets could put more money into the economy. Those selling assets to the Bank of England deposit more money into their bank accounts. So commercial banks have more funds which they can use to finance new loans. And more bank lending supports spending and investment. But this channel is likely to be relatively weak as banks continue to repair their finances in the wake of the crisis. That's why the Bank of England is buying most of the assets from firms other than banks.
And you can see the main focus of central banks, their pinnacle of success is spending. They think the more the consumer spends, the more debt they go into, the richer our society will be.
The extra money the Bank of England is injecting into the economy should increase spending to help keep inflation on track to meet the government's 2% target. Without that boost, the amount of money in the economy would be too low. Spending would be weaker and inflation might fall below target. But as perceptions of an improvement in the economy begin to spread, this will stimulate business and consumer confidence.
And I want to point out there, she's also admitting what I say in almost every video, that in the developed world today, the economies are built on asset prices, debt, and what she just said, confidence. Step number 2, let's explore the Bank of England's video in greater detail using the good old whiteboard. 2 separate economies, the financial economy and the real economy. The financial economy, there's the Fed, bond market, stock market, corporate bond market, and primary dealers, usually investment banks like Goldman, Citi, JP Morgan. The Fed comes in, creates trillions of these currency units out of nowhere, goes into the bond market. That creates more demand for those treasuries. The more demand, the higher the price goes, the lower the interest rate goes. As an example, the 10-year goes from 3% to, let's say, 2%. All that extra money flows down to the entities that sold the Fed the treasuries. Generally, that's banks under the umbrella of the Fed that keep excess reserve accounts at the Federal Reserve. So the cash in their reserve accounts increases. The entities take that cash and look for a higher return on their money because now they're only getting 2% with these 10-year treasuries. So they go into the corporate bond market, buy bonds. Well, this lowers the interest rate of those corporate bonds. This also drives a lot of money into the stock market, taking it to all-time highs. Not necessarily based on fundamentals, but just excess liquidity into the system. The whole point of this financial engineering or quantitative easing is to bring rates down on treasuries, down on corporate bonds, and this flattens out the yield curve, or they try to flatten out the yield curve. They do this because they think it'll increase spending in the real economy. So if interest rates go down, all these people will go out and buy more houses, they'll spend more on their credit cards, and they will buy more Tesla trucks. And I think that actually looks better than the Tesla truck, but I'll let you be the judge of that. We go back to our central bank here with all the hearts around him, and they're just looking at spending with CBMC. And you may be asking yourself, George, what on earth does CBMC stand for? Well, after watching that video, you should know that it stands for Central Bank Man Crush that they have on spending itself. It's an insatiable lust that is unbelievable to me. The reason this won't work is because the Fed and the central banks forget that in order for these consumers that are working for business A, B, and C to take on more debt to spend more, they have to have their incomes go up. They are tapped out. And the Fed and the central banks think that that income will go up if they just spend more. Well, we know that all that will do is create price inflation. The only way that you increase incomes to increase consumption is through production. So why don't we have more production? Why are these business owners not investing money to make their employees more productive? Well, this is pretty obvious because the Fed comes in with all this financial engineering and puts a put on the stock market, the corporate bond market, and the real estate market. And when I say they put a put on the market, it means they won't let it go down. So these business owners say, why on earth should I spend my extra money on increasing productivity when there's a little bit of a risk there? All I have to do is take this money and put it into the real estate market, the stock market, or the corporate bond market, and I'm gonna make risk-free money. So you have less productivity, less income, less debt, less spending. In the real world, the way this plays out is the retail banks are supposed to be the transmission mechanism for getting all of this liquidity from the financial economy into the real economy. They do this through lending. But since they're not able to lend anymore because there's just not demand for those loans, it creates this wall. It makes the transmission mechanism completely impotent, and this wall traps all of this liquidity in the financial economy. This takes the bond market to all-time highs, stock market all-time highs, corporate bond market all-time highs. It creates the everything bubble, which only accomplishes one thing and one thing only, and that is to create and exacerbate wealth inequality. Step number 3, I answer the question, will quantitative easing cause hyperinflation? My answer is no, it will not. But what it will cause is a huge discrepancy between the haves and the have-nots that will totally wipe out the middle class. And that will bring on MMT or helicopter money. Why? Because it's the only way that the Fed can get the liquidity from the financial economy over this wall, around the banking system, and into the real economy. It's the only solution they have. It's not the right solution. Let me be very clear. But all they have is the money printing tool. And when all you have is a money printing hammer, every single problem looks like a nail. And the Fed will continue to nail and nail and nail until we get severe inflation, if not hyperinflation. For more information like this, check out this content right here, and I will see you on the next video.